Hello everyone. Welcome to my Workbook Solutions videos for Managerial Accounting. This video covers Chapter 24, Capital Investment Analysis. Please note that if you are watching this video at a much later date than it was posted, the chapter number may have changed as well as the page number of each example in your workbook. Overall, that shouldn't matter as the example problems we'll work through will still help explain the material. I'll also show the question in its entirety within the presentation, so you won't actually need a physical copy of the workbook, though having one will make the process much easier for you. Without further ado, let us proceed. We'll start on page 1. Let's apply some investment analysis to the following two projects, A and B. In the top table, you see the respective costs, expected lives, and residual values. In the bottom table, you'll find their expected returns, as measured both by net income and cash flow. All covering their 4-year lifespans. The difference between annual income and annual cash flows from each project is depreciation expense. $140,000 per year for Project A and $225,000 per year for Project B. Determine the payback period and the accounting rate of return for each project, starting with the cash payback period. The most intuitive way to determine this time period is to determine each year's accumulated cash flow. For Project A, as soon as you make the purchase, you're $560,000 in the hole. But as of the end of that first year, after earning $150,000, you're only $410,000 in the negative. In year 2, you would earn $190,000, bringing the deficit to $220,000. Year 3's cash flow is $220,000. So by the end of that year, the deficit would be gone. 3 years is all Project A needs to recover its investment. For Project B, its initial investment puts you $900,000 in the red. Year 1's cash flow brings you to negative $575,000. Year 2's cash flow brings you to negative $250,000. But by the end of year 3, you're at positive $75,000. Project B therefore recovers its $900,000 after the end of year 2, but before the end of year 3. How far into year 3 must we go to hit that $0 mark? At the end of year 2, we're at negative $250,000. And throughout the entirety of year 3, we earn $325,000. Divide the cash we need to break even by the cash that will be collected, and we only need 77% of year 3 to get to 0. So the cash payback period for the project is 2.77 years. If you don't quite follow why that math works, think of the matter as a timeline. At the end of year 2, we're at negative $250,000. At the end of year 3, we're at positive $75,000. We get to that number by adding the $325,000 cash flow from that year to the negative $250,000. In other words, 77% of the $325,000 year 3 cash flow is the $250,000 amount we need to bring accumulated cash flows to zero. Yet another way you can solve this problem if cash flows are even each year is to merely divide the initial investment by the annual cash flow. Which is 277. Allow me to make some space to record our results. Now let's tackle the accounting rate of return. The accounting rate of return is the quotient of the estimated average annual income divided by the average investment. The average annual net income is determined by summing each year's income and dividing that sum by the expected life. The average investment is just the sum of the beginning and end of life book values divided by 2. A project's beginning book value will simply be its cost, and its ending book value is its expected salvage value. For Project A, its average investment will be $280,000. Project A's total income sums to $224,000. Divide that number by its 4-year life to get its average annual net income. $56,000. Divide the $56,000 by the $280,000 and Project A's accounting rate of return is 20%. Now for Project B. Average the $900,000 cost with its $0 residual value to get its average investment. $450,000. Average its total income over 4 years to get the average annual net income. $100,000. So Project B's ARR is therefore 22%. So which is the better investment? Project B. Despite its higher buy-in amount, it provides a faster payback period and a slightly higher return. Turn to page 3 for another example on ranking projects. In case 1, you see 3 projects with their present values of future cash flows, their initial investments, and their respective net present values. Which of these projects would be the best investment? A, B, or C? Obviously, Project B, because of its highest net present value. Project A would be the next best option, and Project C would be last. Evaluating these projects based upon their NPVs only works in this instance because they all require the same dollar investment. These rankings are a little less obvious in case 2, where the projects have different buy-in amounts. Going by their NPVs, Project B would be our first choice, followed by Project C, and then Project A. However, their differing initial investments necessitate a little more analysis. Instead, we can divide the present values of their future cash flows by their investment amounts to yield their present value indices. Project A therefore has an index of 1.2. Project B has an index of 1.19. And Project C's index is 1.21. So Project C is the best option in terms of how efficiently the investment provides a return. Project A is number 2, and Project B is still third, despite having the largest net present value. Applying this analysis to case 1 would not impact its rankings. Turn to page 4 to consider a more in-depth problem. A company is planning to buy a new machine at a cost of $200,000. The machine is expected to last for 10 years and have no salvage value at the end of its useful life. Straight-line depreciation will be used. The company expects to save 10,000 hours of direct labor each year because of the new machine, as well as $4,000 each year in other operating costs. Management's best estimate is that on average the hourly rate for the labor saved will be $5.50. With the exception of the initial purchase, assume all cash flows take place at the end of the year and at a tax rate of 40%. Let's work down this list, starting with calculating the payback period on the investment in the new machinery. The formula for the cash payback period is the initial cost divided by the future cash flows. This machine isn't going to create future cash inflows so much as it's going to reduce future cash outflows. So we'll use our future cash savings as our denominator. We have the cost of the machine at $200,000, and the new machine will save $4,000 in operating costs each year. However, it will also save 10,000 hours of direct labor per year. Multiply those hour savings by the direct labor rate of $5.50 an hour and include that in the denominator. The labor cost savings are therefore $55,000, and total overall savings comes to $59,000. The cash payback period is approximately 3.39 years. Number 2, calculate the rate of return on the average investment. This is another term for the accounting rate of return. We return to the same formula used in the first problem. The average investment is usually the easier calculation, so let's start there. The beginning book value is just the cost of the asset, and since this asset has no salvage value, its ending book value is 0. Sum those two numbers and divide by 2 to get $100,000. Now we can address the average annual net income. Sum the annual net incomes for this investment, then divide by its estimated life. Allow me to clear some space for these calculations. The investment's life is clear, 10 years. As for its net income, remember, this project doesn't generate income so much as it reduces costs. So we need to figure out the total cost reduction per year. We already established our cost reduction in terms of cash savings. This $59,000 is the sum of the reduction in labor and operating cash payments. However, when calculating accounting net income, we need to include non-cash costs or expenses. In particular, we need to include the machine's depreciation expense. This machine has a $200,000 cost, a 0 salvage value, and an estimated 10-year life using straight-line depreciation. So its depreciation is $20,000 a year. Net the cost savings with the additional depreciation expense, and the net savings will be $39,000 a year. There's one more expense we need to consider though, the income tax expense, which is 40% of that $39,000 or $15,600. The annual net income, I put in quotes because this amount is not net income, but expense savings, is $23,400. Multiply this annual amount by the 10-year life to get the total net income of $234,000. Of course, if we divide the total cumulative net income by 10 years, we're back at $23,400. So we could have stopped one step sooner in the previous slide. Still, it's good to observe the entire process until it becomes more intuitive. This project's rate of return is consequently 23.4%. Step 3. Calculate the net present value and the profitability index. Note that the profitability index is just another term for the present value index we've seen already. Let's calculate these two items ignoring income taxes and using a discount rate of 10%. We've already calculated everything we need to start this problem. It's just a matter of picking out the relevant numbers. We need to take our future cash flows and multiply them by the appropriate present value factor to determine their values as of right now. We know we're going to save $59,000 in cash every year. What about depreciation? Depreciation is a non-cash expense. It doesn't represent a future cash outflow, so we don't include it. However, the income tax expense is a future cash flow. We will have to remit this amount to the IRS in the future, but this calculation is ignoring income taxes, so we will do the same with this amount. To get the present value of these future cash flows, we multiply them by the present value factor. Do we use the present value of an annuity or a single amount? An annuity. These future cash flow savings are occurring every year for a 10-year period. That's an annuity. Now we need to pick out the right factor on the present value of an annuity table. It's easy enough. We know the time periods as well as the interest rate. Find the appropriate row and column on the appropriate table. The relevant present value factor is 6.1446. The present value of the annual $59,000 in cash flow savings is $362,531.40. To get to the net present value from the present value, we subtract out the machine's initial cost of $200,000, which will be $162,531.40. To get the profitability index, or present value index as it is sometimes called, divide the present value of the future cash flows by the initial cost. $1.813. Let's calculate these two items once more, but this time including the impact of taxes. We'll still use the 10% discount rate. We'll still include the labor and operating cash flow savings. Depreciation expense is not a cash flow, so we don't include that amount in our future cash flows. But we do consider the future income tax payments in this analysis. Net those cost savings with the additional cash expense to get net cash savings of $43,400. The annuity factor will not change because we're still using the factor for the 10-year time frame and the 10% discount rate. So the present value of these annual net cash savings is $266,675.64. Subtract out the initial cost of $200,000 to get a net present value of $66,675.64. Divide the present value of the future cash flows by the initial cost to get an index of 1.333. Turn to page 10 to look at our final problem. The management of Advanced Power Alternatives is considering two capital investment projects. The estimated net cash flows from each project are as follows. The first column indicates that these are both 4-year projects. The second column shows that the wind turbines project generates a consistent $280,000 a year. Likewise, the biofuel equipment project also generates a steady $300,000 every year. The wind turbines require an investment of $887,600, while the biofuel equipment requires an investment of $911,100. No residual value is expected from either project. Your book may not have the following specified, depending on when you're watching this video, but presume an interest rate of 6%. If you like, pause this video and see if you can determine each project's payback period and net present value. Starting with the cash payback period. The wind turbines have an initial cost of $887,600. The biofuel equipment's initial cost is $911,100. Divide the wind turbines' costs by their annual cash flows of $280,000 a year to get a payback period of 3.17 years. Divide the biofuel equipment's cost by $300,000 a year to get a payback period of 3.04 years. Number 2. the net present value. First, calculate the present value of the future cash inflows. 280 grand a year for the turbines and 300 grand a year for the biofuel equipment. Multiply these amounts by the appropriate present value factor of an annuity. Find the factor for 4 years and at 6%. $3.4651. The present value of future cash flows for the wind turbines is $970,228 and $1,039,530 for the biofuel equipment. Now determine the net present value by subtracting each project's cost from its respective present value. $887,600 for the turbines, $911,100 for the biofuel equipment. So the net present value is $82,628 for the wind turbines and $128,430 for the biofuel equipment. Hopefully, you were able to calculate these 4 amounts on your own without much difficulty. Now let's look at the internal rate of return. I promise I'm going to streamline this calculation for you. The formula for determining the present value of a future series of payments is the future cash flow times the present value of an annuity factor. We can solve this equation for the present value factor by dividing each side by the future cash flow. So the present value factor equals the present value divided by the future cash flow. The present value for each project is how much we must spend right now to invest in it. For the wind turbines, it is the $887,600 cost. For the biofuel equipment, $911,100. Divide these costs by their respective future cash flows of $280,000 and $300,000. The wind turbines have a present value factor of 3.17, and the biofuel equipment has a present value factor of 3.037. Now, these numbers should look familiar to you. That's because they are the same numbers calculated for the payback period. The formula for determining a project's payback period is the same for determining its present value factor. The numerators are just given different names, but that doesn't change the fact that a project's initial cost is the same thing as its present value. So when you're trying to solve a project's internal rate of return, if you've already calculated its payback period, just use that number as its present value factor. Next, we need to go to the present value of an annuity table and identify the interest rate of each project. Both projects conveniently have a 4-year life. Looking across row 4, we need to find the factors that most closely align with the factors we calculated for each project. The wind turbines have a factor of 3.17, and at the 10% column we find a factor of 3.1699, which rounds to 3.17. 2 columns over we find a factor of 3.0373, which is close enough to the biofuels equipment factor of 3.0370. Therefore, the wind turbines have an IRR of 10%, and the biofuel equipment has an IRR of 12%. So which of these projects is the better investment? The biofuel equipment. This project has a slightly shorter payback period, so we would get our investment back just a little bit faster. It also has a higher net present value and a higher rate of return. That concludes this video. There may be one or two problems in the workbook I didn't cover. If so, you can find their solutions in the course module on Blackboard. I encourage you to try them on your own to test your own proficiency and retention of the material. Please let me know if you have any questions. Thank you for watching.